All right, so why don't we go ahead and get started? So again, welcome everybody. I'm so excited that you decided to join us today on your Wednesday. I'm Stacey Salyer, Property Management Strategist. I have over 20 plus years in the experience in property management. I have started businesses from the ground up. I started my own company from my living room, actually, back in 2016. Then in 2020, I purchased a property management company in my local market. And then I eventually sold my company to Pure, and then I joined the acquisitions team. So I have done acquisitions on a national level as well. So have seen quite a few different deals from my own personal to national. And I invited Jordan Coleman with Live Oak Bank to join me today to talk about doors to deals. So Jordan, you want to go ahead and introduce yourself?
Yes. Thank you for allowing me to join this Doors to Deals webinar with you. I'm super, super excited just to hear everything about what you have to say, learn a little bit more about what you're doing in this space, questions from anyone in the chat, explain a little bit about what we do here at Live Oak Bank. I am a loan officer that runs our property management lending division. And what we do there is we are essentially helping property management owners and companies with financing. So we are at Live Oak, #1 SBA lender in the country, which does make us a little bit unique. But the most unique part about us is that we build out specific teams and industries. So we find industries and verticals that we feel are a little bit underserved from a financing perspective, and individuals and companies may not know or realize that there are other financing options to kind of help grow their business a little bit quicker by acquiring other property management companies or refinancing existing business debt, working capital loans for your actual true organic growth, whether that's advertising expenses or payroll expenses to help grow and expand your business from that perspective. Really excited to be here. I've been with the bank for about 9.5 years now, closed loans with attorneys and on the legal side for about 4 of those years, and then been on the lending side for the past 5 years. Just really appreciate the opportunity to join you on this webinar.
Awesome. Yeah. Thank you for joining. All right. We're going to just show our faces now. Again, as a reminder, just go ahead and close other browsers, put your phones down, sit back and take a listen. So we were trying to make this kind of as conversational as possible and thought we would just jump in and why buy a property management company. So for those of you that are listening that have started a PMC from the ground up, you probably know the answer to that. It is quite the slog to start a PMC from the ground up. You've got everything, anything and everything you have to put together yourself. So looking at why you would want to possibly buy one is there's several different reasons. One, of course, is instant cash flow. If you don't have experience in running a property management company, they actually are something really good to buy. Skip the startup struggle, of course. Accelerate your growth. I was able to do that in 2020. I went from pretty good size to really good size quite quickly. Depending on the purchase, you could be buying a built-in team and infrastructure. So we'll talk a little bit more about that. Market expansion or consolidation. So again, when I did acquisitions on a national level, that's something that we did was we worked on market expansion across the US. When I did it as a personal, I worked on market expansion at a local level, strategic leverage, and building toward exit or passive ownership. So those are just some of the reasons. I was always asked why I decided to buy a PMC, and it was basically just to add doors, and it made it much easier than going out and just focusing on one at a time. Most of the people that we manage for kind of that mom and pop, like the 1 to 4 door owners, and it's a lot easier to go in and acquire a PMC, but you have to make sure it's the right deal. And that's where it can get a little bit tricky because not every deal that's presented to you is the best deal.
No, and it takes a lot of work to start up a property management company, but really any company to truly start from the ground up. A lot of blood, sweat, and tears. So kudos to anybody that has done that. I know that you put in a lot of hard work, but just like you're saying, Stacey, if you want to make sure that the business that you're looking to acquire has the right business model, the right fit, the right staffing, the right systems in place. And it seems to be a good fit and company that fits your growth model and your business plan. But yeah, startups, they're very hard to get where you want it to go and at a quick pace.
Oh, yeah, for sure. Because I know when I started Leading Edge Property Management, like I said, I started it from my living room. I was a single mom of 3 kids, took a huge pay cut, just said, I want to go out on my own and I had this vision. And that was basically my 4th child. I involved my kids. We did like team meetings and took them to like team dinners when we hit our sales goals and that kind of thing. But anything and everything that was leading edge, I had basically created in some form or fashion. And it was really great in 2020 to be able to look at my local market and say, okay, I'm going to add some additional doors. That's going to bring in quite a bit of revenue, be able to grow out my team and become more of the CEO versus the doer.
Yeah. The American dream.
Yeah. It is American. Sure. Yeah. There are different deals that you can do. And I guess maybe we'll talk about financing if you guys finance all the kind. But one very popular one is usually an asset purchase. So you're just purchasing the contract. And that, like when I did acquisitions on a national level, we did like a hybrid. We would look at, depending on the market, we would look at the contracts, of course, but then sometimes we'd look at the team as well. So it just depends on what you're looking at as far as like growing your company. Do you need the staff that the company already has? Do you just want the contracts? Are the contracts assignable? Can you bring them on? Like we're asking the seller, all those are really important questions about why are you selling? What are you trying to gain? Are you leaving the business for good? Are you just moving out of the area? The other is you can do a stock purchase. So you can actually just purchase the entire corporation. Those aren't as popular, I found, across the US because there are pros and cons. So one of the cons is you do end up buying any potential liabilities versus just buying the contract. So tell me, Jordan, do you fund loans for all those kind of styles or what do you guys focus on?
Yeah. So we don't necessarily have a preference on if a buyer wants to look at this or a seller wants to look at this as an asset purchase, which you're buying your management contracts, you're buying the systems, the employees, or if you want to do a stock purchase and kind of purchase the company as a whole. Like you said, there's pros and cons to both. So we always say advise with attorneys and accountants and make sure that it makes the most sense for you. There's a little more liability on the stock purchase, but you may not have to sign contracts over on a stock purchase, where on the asset side, you have less liability that's going to be tied to an acquisition, but you may have to start assigning some contracts over, which could be a little bit of attrition there. So whether we look at this as an asset purchase or a stock purchase, do typically look at it on a cash flow basis. So we're really making sure that the business that you're looking to either acquire, or if sellers are getting geared up for potential retirement, you want to make sure you have your books in place, you're ready to have an idea of what that exit strategy looks like. We look at a cash flow on either side of that opportunity and really making sure the business that you're either looking to buy or sell can support the purchase price that's being asked for. And then, of course, we can look at adjustments like you had mentioned. Maybe you don't need all of the staffing in place. Maybe you've got an existing business that's got the staff that can handle these additional 50 or 100 doors. And there's expenses that we could look at cutting to kind of help the business's overall cash flow. And in those scenarios, at the very end of the day, if we know that there's expenses that are going to be cut and you can commingle these businesses into one conglomerate business for you as an independent individual owner, it's just going to be that much better of a cash flow. But you definitely want to make sure you understand what's coming with the business. What do the contracts look like? What is the concentration of the portfolio that you're acquiring? Is it, one or two owners that own a majority of the doors? Could be a little bit of a risk for you as a buyer. What are the length of the management contracts? What does the staffing look like? Does it all kind of mirror and match what your end goal and your business plan looks like for you to acquire that business. So long story short, yes, we can finance both of those, really up to the buyer on how they would want to structure that.
Okay. Yeah. And you bring up some really good points because that is something. So going back, you guys deal with the money part of it, but on the front end, I always dealt with more kind of the emotional part of it, right?
Yeah.
Because everybody thinks that their business is great, and it is. There are so many different factors that you have to look at when you're looking to purchase. Number one is definitely your client mix. You don't want to be buying something where it's concentrated on maybe, let's say you have 500 doors and they've got 5 big clients. That would be a huge red flag for me. That would not be worth as much, because if you have one of those clients leaves, then you're out all that money. So looking at like a clawback period is really important for sure.
Yes.
Usually I recommend at least like a 6-month at the minimum.
Yeah.
And the mix, and then the length of the contract. So if you've had a lot of turn, people haven't been a client for such a long time, that's definitely could be a red flag. But it can also be a challenge if they have been a client for a long time too. So the deal that I ended up purchasing in 2020 was interesting. Every time you do something, you learn something new, right? This gentleman had been in business for years and years. One big difference that when I went into it, I thought would actually be a really good benefit, but I would say that some of the clients didn't really love the way I ran my business. So I ran my business very like high touch, high tech. So we utilized a lot of the prop tech that had come out, because when I started in 16, a lot of that kind of stuff came out. I offered some really great programs to my residents and clients. We did walkthroughs on our homes. The company that I bought, the business that I bought, he just basically collected rent and did turns. That was it. Like he didn't do walkthroughs, and it just wasn't part of his management agreement.
Yeah.
So there was a positive in that. It wasn't part of his management agreement. But when I started to try and get the clients onto my agreement, they didn't necessarily value what I was doing sometimes. And he did run it pretty old school. Like literally they were handwriting tenant or owner ledgers.
Oh, geez.
In the mail in 2020. I did struggle with some clients that thought that our computerized statements were just a little much. Overall, I would say probably like 98% of people were very thankful for the way I did run my business, but I was shocked at the 2% that were like really standoffish and didn't like that. So those are things that when you're looking at a business, you do have to look at how you're currently running your business, and then be very realistic on the time frame of what it will take to get that new portfolio wrapped into your current business. So
how long did it take for the transition period for you when you acquired your business for you feel like, okay, I feel like I've touched all of the clients, it's smoothed out? Did that take a couple months? Did that take just a couple weeks?
No, realistically, it probably took a good 6 months.
Yeah.
At least. Yeah. But this was several hundred doors.
Yeah.
Yeah. And then it was a pretty big purchase. And so about a year into it, there was actually about 110 doors that just did not fit my portfolio at all. So I actually went and sold them to a different company in my market. So did some rearranging here and there.
Yeah.
And I did some creative things. And I think that's one thing that when I've given advice to people over the years is I just say, stay open-minded and treat this like it's an asset for you. So it's an actual business that you want to make money off of. It's not like I wasn't emotionally tied to any of those contracts.
Yeah. And sometimes it's just a handful of tougher doors that can make it hard to, you just have to let them go. It makes the most sense on this is not, you don't fit kind of the portfolio that I'm looking for. It's for some reason, we're just not able to meet eye to eye. And sometimes that's the best route to go on. Let go of the ones that are maybe draining the time and find and acquire those that are going to be able to, you're going to be able to add it on and give you more time somewhere else to organically grow, to look at your marketing, to sit down and think about how can I grow my business?
Exactly. Yeah. And it doesn't help your team if it doesn't fit your model for sure. But at the end of the day, you should treat them like they're worth something. And so I'm not a really huge fan of just like releasing a client. I'd rather sell it than because it worked for somebody else in my market. they
Yeah.
managed that kind of portfolio and it worked really well. So it was a win-win for all. And then I kept what I needed and grew a beautiful company that was eventually acquired. So it worked out really well.
That's great.
Yeah. So what do you guys look for? Do you like as far as like sellers or buyers? So like when people are coming to you and they say, "Hey, I want to get financing." Do you have a checklist of things that they need to do ahead of time, or what do you guys look for?
Yeah, so we really look at this and can attack this at a couple different angles. So we worked with buyers before in the past where they come to us and say, "Hey, I've got an existing property management company. I know I want to acquire in my market. I just have not found that right business quite yet." To me, the best route there is, "Hey, let's go ahead and connect. Let's have these conversations. Let's get you and your existing business pre-qualified. So that way you have a somewhat of an approval on you individually of,
Mhm.
yes, you guys are most certainly, you run a well-sound business. We're able to speed up the process, how we look at cash flow, because we will want to do the same scenario on an existing business as well as a target business and try to be as educational as possible on this is how we analyze and look at cash flows. This is maybe where expenses could be cut. But overall, it's always a good idea to go ahead and have the conversations, have options to when you do find that right opportunity, you know what to look for, you know what to ask for. And typically, when sellers are ready to sell, they want to sell pretty quickly. So you want to go ahead and start that and get that started. And what we typically ask for there is 3 years of tax returns, interim financials, and a rent roll questionnaire that we've completed that really helps us to understand the buyer as well as the seller's portfolio in general. Is it high concentration? Is it in your market? What do the leases look like? Do you have any idea about the staffing? So it's always a good idea to get pre-qualified as a buyer. And then on the other hand, we also pre-qualify sellers. So if there is a seller that says, "Hey, in 6 months, I know I want to retire to my key employee, or I know I want to put my business on the market for sale or sell to a competitor," we look at pre-qualifying seller businesses of, "Hey, okay, this looks great. This is what the bank can get comfortable lending to." Because again, we want to make sure that whoever's buying is able to support its own respective debt. So we most certainly look at pre-qualifying both buyers as well as sellers, just depending on their scenario and what that looks like for them.
Very cool. Yeah. And so we have a couple questions. So one about due diligence. So going to, and I can let you talk about the due diligence on the finance side, but I'll say like in the beginning part of it. So if you are looking to buy a PMC, there's some basic due diligence that you want to do. Number one, always approach it with an open mind. So I would say don't just jump in and be like, "Oh, I need to add doors. I need to add doors. So I'm just going to do this deal." Not every deal is equal.
Yeah.
Not every deal is good. So number one, ask the seller why they're selling.
Yeah.
Maybe it's retirement. Maybe it's a fire sale. Maybe it's obvious. Maybe you know the answer, but maybe it's burnout. There's could be a variety of reasons. So sometimes those reasons will also just dictate the overall health of the company and all that. And then number two, so then you're looking at like door count, you're looking at like mix of door count, then you're looking at what exactly they're managing. Does that flow with what you currently manage? I specialize in single family management, so I needed single family management. That's what I was looking for. I wasn't looking for commercial or anything large apartments. And then when I was doing acquisitions on a national level, we just had a list of pre-qual questions that we would look at. Like, what is their average rent? What does their delinquency look like? What do their processes and systems look like? Do they have a team? Do we need the team? What software are they using? Will it be easy to assign the contract and kind of all that? And just basically have this like checklist of just the start of the kind of due diligence, and then you dig in deeper from there. But what about you guys, Jordan? What do you guys look at?
Yeah. So we look at very similar items on a due diligence side that you're referencing. We want to look at trends. Have they been losing doors in the past 3 years? That's a red flag. Has revenue gone down in the past 3 years? Let's understand in figure out why. Do they have just not a great reputation and people are leaving? That's going to be a risk for a buyer to buy a business where there's not a ton of great reputation on that business. They've lost doors in the past 3 years. So trends are going to be important to look at as you're buying a business, as well as staffing. Have they lost a lot of staff? Do they have a ton of staff turnover? That could be a potential red flag internally on the environment of that company. So those are some key things that we look at from a very high level perspective of an overall trend of the business. And then, like you're mentioning, Stacey, you want to make sure as a buyer that the due diligence in the portfolio you're buying makes sense for you. If you're mainly focused in single family, commercial portfolio may not make sense. A large apartment complex may not make sense. There's a lot of different complexities on kind of the asset that you're looking to buy. So understanding what you're buying, what the trends are looking like, the concentration of that company are all very key factors in good due diligence that a buyer needs to be understanding and looking at when they're buying a property management company, as well as the average rent. Does that average rent fit with the market? Are they undervaluing the rent? Is there a potential increase in the rent? That's another key component to look at and analyze as a buyer as you're looking at this. From a financial due diligence, what we typically look for is, again, going back to that cash flow base. So we want to make sure that target business that you're acquiring is really able to meet our debt service coverage ratio when we're underwriting these transactions. And so essentially we underwrite to a 1.25 debt service coverage, meaning for every dollar of debt the business has, it's got $1.25 to make itself back. So we want to make sure that trends from a top line revenue and door count make sense and are not declining. But same goes for your bottom line debt service coverage. We want to make sure that the business can support its own debt from an underwriting cash flow scenario that makes sense for a buyer. And in order to do that, again, it goes back to that 3 years of tax returns is typically a minimum starting point of what you want to ask for, year-to-date interim financials, and then understanding the trends that Stacey and I spoke about on door count concentration and what that looks like as a portfolio.
Yeah. And then somebody asked about a multiple. So I know that is very complex. Nobody can really just answer, oh yeah, you should be able to buy a PMC at whatever multiple, because there's so many different factors that go into it. Even down to the fact of the seller most likely isn't staying. Is the seller like drawing an actual real salary from the business? You got to back that out. You got to back out whatever, all this stuff. So I'm assuming you guys don't have just like a common multiple.
Now, I would say that we've got a starting point on what we look at from a multiple perspective. But like you said, each transaction is different. Is the seller staying on? Are there adjustments and add backs that make sense? So I know that there's a ton of different ways on how you can quote unquote evaluate a property management company. From us in a lending perspective, the way that we analyze and look at that is a cash flow based off of adjusted EBITDA or adjusted net operating income. And so what that is, that includes the business's bottom line net income that they've reported, plus any potential adjustments. So for example, a seller pays himself $100,000 salary, that'll be going away post-closing. And you as a buyer say, I don't need to replace the seller. I'm already pulling a salary from my existing business. So that's really going to be free cash flow for you going forward. We would look at an adjusted EBITDA figure, an average 3-year adjusted EBITDA. And typically anything with 150 doors or less, your multiple could be anywhere below 2.5 times. Again, depending on door count, the geographical region. Some markets may have a little bit of a lower door count, but they require higher rents just because of where they are. They may have a little bit of a higher multiple because of that.
Right.
Anywhere where you're getting 150, 200 doors or more, you really could be anywhere between 2.5, even up to 4 times if cash flow can support it from that debt service coverage perspective. And it makes sense for kind of the overall picture of that buyer. That would be my very high level overview of how we look at and analyze a multiple, but it's all really going to be dependent on the specific business, the specific buyer, and that specific seller. Each buyer is very unique and changes cash flow one way or another. Some buyers have to pull a larger salary And if that's the case, well, we need to bring our multiple down. We need to bring the debt down. We need to make sure that it makes sense for each specific buyer. So I hope that helps answer that question. It's a little generic on my
Oh
answer,
yeah.
but
No, I think it does. I think that's the thing is out there in the internet land. It's everybody always wants the exact answer. And it's like every transaction is different and everyone is different. And then we got a question about clawback. What I have typically seen is 6 months. I haven't really seen much longer than 6. I think 6 is very reasonable. That's what I did when I had my deal, although my deal was a little bit different the way we worked it out. But that is something that you definitely want to have planned out ahead of time is what is the seller doing? So is the seller going to help you with that transition? I recommend that. I do not recommend the seller just piecing out, taking the keys for the office one day and be like, here you go, and like walking away. You really want the help of that seller to help guide your current clients and that experience over into your existing business. But that can definitely make or break you as far as that during that clawback period. So if you only have 6 months and you've got to reassign all those contracts, that needs to get done like right away. You need to make sure that you've got things pre-planned based on the clawback period.
Yeah. And I would agree. I am from the bank side as well as a buyer side. Clawbacks are protection for a buyer for transition, and I think they're very important. And so we've seen a callback from 6 months. We've seen it 12 months. I have not seen anything go over 12 months. I don't think it's really necessary after that. After you've been in the business for 6 months to a year, you should have everything already lined up and ready to go and implemented as your existing business. But I do think if there is a callback, that's a conversation that you need to go ahead and have with the seller, that this is how we're structuring it, whether it is seller note, whether it is bank financing. So you've got an idea and you guys, buyer and seller, have agreed to this kind of structure, but all for a clawback period.
Yeah, absolutely. Yeah, very important. And then we have another question. What type of terms are offered? I'm not sure if they mean like loan wise or just in general, but the thing is when you're buying anything, so whether it's real estate, if you're buying a home or you're buying a business, every transaction is different, right? You can write up any terms you want in your contract, but I guess the standard is at least a 6-month clawback. And then you're outlining, what each door is worth. So if you lose a door, then you would not get that back. Oh, loan terms. So I guess they wanted to know what kind of loan terms you guys offer.
Yeah. So for business acquisitions, from loans 10,000 up to 7.5 million, which is very wide range, but what we can finance. It's a 10-year loan term, and this is on kind of that SBA guideline and rule structure on how we're looking at this. And even though that this is, I know I talked about this at the very beginning, but structured as an SBA loan, we are able to do everything on behalf of the SBA. You as a buyer are really just benefiting, and seller potentially, from a longer loan term. So the debt's amortized over 10 years. So you've got 10 years with no prepayment penalties, no balloon payments involved to pay that debt back. You can, again, pay it down as aggressively as you'd like if cash flow allows. And if you are looking at acquiring an existing business, so you've got a current property management company, you are looking to acquire and expand a second or third property management company, you as a buyer are essentially eligible for 100% financing to where you don't have to put cash down. Now, you may not want that, or Stacey as a consultant may say it's better to put cash down and put not as much debt on the business, but you are eligible for up to 100% financing for that 10-year loan term, if that's what makes sense for your structure. So we will definitely can talk through different structures. What does this look like? We want to cater this to you as a business owner. Does the seller want to hold a little bit of paper and then get the rest as bank financing? Do you want to hold seller note as a clawback and then the bank finances the rest? So multiple different versions on what this could look like. But from a banking loan term perspective, it's going to be a 10-year loan term.
Very cool. Okay. And then let's see, somebody said, I've heard seller finances around 20 to 30% on SBAs these days. Is that realistic? So sellers carrying around 20 to 30%. So I know when I did mine, I did not use an SBA loan. Actually, the seller financed. So I just put a little bit of cash down and then just worked out a note payment for him. He was looking to get out of the business. He was looking to retire. So it was basically his way of getting paid without the major tax implications.
Yeah.
Because that definitely can be a big factor too. So if you're selling a company and you're like, oh, I want a few million up front, you're going to be in a different tax bracket than if you just get paid out year over year. So that's something to keep in mind as well.
Yeah. And I would just say the seller note portion and the bank portion, you and the seller can really structure that. If the seller says, I want to do a 50% seller note and 50% lump sum at once, as long as the seller note is subordinated to the bank, there's really no issues on how buyers and sellers want to structure their transaction. But buyers can put in a minimum of 10%. So there's a minimum 10% equity injection requirement for first-time acquisitions. And then you are eligible for up to 100% financing on your second, third, or fourth acquisition as you're growing, or refinancing debt, working capital loans. So it's really dependent between buyer and seller on how they want to structure seller note financing.
Very cool. What are the rates right now about?
Yeah, it's going to be dependent on the overall business, the credit of that individual. Rates are based off of prime, which prime rate today is 7.5. So you're going to be looking at prime rate plus your spread. And that spread could be anywhere from prime plus 1.25 to prime plus 1.5. Was probably, I would say, our average on a unsecured business loan. But there's also a couple different factors that vary that kind of help dictate what that rate looks like.
Very cool. Okay. And then it says, when doing seller financing, how would you protect yourself if the buyer defaults? Well, have a really good contract. Have a good attorney up front. And I think that's another key piece, is that if you're thinking about buying a property management company, it's usually not something that you're just like heading down to TJ Maxx one day and you're like, oh, I'm going to
do this.
Yeah, I'm going to go buy this thing, right? It's not quite the same as going to buy candles. So you want to make sure that you're preparing yourself ahead of time, that you're getting your team together. You've got a really good CPA. You've got a really good contract law attorney who understands like buying and selling businesses. You've done your due diligence personally, like you've had conversations with people like Jordan. Or at the end here, I'm going to share with you a workshop that I've created that you can purchase, and it has all these cool tools in it. And so you can learn more on that, and that you've really started to create your team for you. And then that was another question that I've gotten over the years as well, is like, how do you find property management companies to buy? So in my market, again, looking holistically, like looking at the United States, right? There's thousands and thousands of property management companies, from small like realtors who just have like a book of business that have been doing it on the side, that may just want to get out of the game and they're done doing that. They just want to sell their contracts, to large companies that are aging out. We do have the baby boomers that are starting to age out. So I would look first in your local market, go through Google, see who's who, get to know people. Obviously, if you're NARPM members, you're probably going to know most of the people in your market, but yeah, same. Trey said that as well. NARPM may help, but just take a look and let people know that you're looking to buy. I think that's the number one key. That's how I got my deal. I was talking to a local attorney and I said, hey, just so you know, I'm looking to grow. Obviously, I'll continue to grow the old school way, but if you know of anybody looking to sell their company, I would love the opportunity to have a conversation. And that's how it started, and that's how it ended. But put together your team first and make sure that you've really trained yourself to know exactly what to look for.
Yeah.
Let's see. When buying, do you require non-compete from sellers? Yes, I did. And I highly recommend that.
And we require it as well.
Okay. Yeah. And do you guys have a specific mile radius for that, or is it
there's not like a cut and dry, just like everything else, not like a cut and dry radius or time frame, but we do want to make sure that it makes sense, that it's not half a mile for 6 months. That's probably going to be not acceptable to the bank. You want to make sure that you as a buyer are going to be protected and that it really truly makes sense for what you're looking for on the non-compete, but we do require non-competes.
Okay. Yeah. Yeah. And that's pretty normal. And I would say if you're talking to a seller and they're not willing to do that, would be a red flag.
Yeah.
Just remember, not every deal is a good deal.
Yeah.
You've got to ask all the right questions. Let's see here. Would doing sales only be part of a PM agreement non-compete? So it really just depends. Again, every transaction is different. And so when I sold my company, doing real estate sales was not part of my non-compete because it's not property management. But again, it just depends on what kind of transaction you're putting together. When I sold my PMC, my non-compete is only around property management, specific radius and for a specific time frame. When I bought a PMC, I did not exclude real estate sales because that's not why I was purchasing the book of business. So yeah, any other questions out there? We would love to answer them. Feel free to drop them in the chat. And do you have other stuff you'd like to add too, Jordan? Is there anything that we didn't talk on?
I feel like the 45 minutes went by a lot quicker than I was anticipating.
It always does.
No, not really. I think we've hit a lot on the due diligence side. I guess I would just finalize and finish up on find the right partners for you as a business owner. Do due diligence on what you're looking to buy. Does it make sense? And find what makes sense for you and know what you want to do with that, and rely on your partners that you meet, consultants, the lenders that understand property management and can help guide you and share with you and educate you on what this can look like for you is very important as you're looking to grow, buy, or sell.
Yes, absolutely. So yeah, and I'll take this time to introduce everybody to something that I created. I've been asked for things like this before in the past. And so this is the first time that I've written this one, but I wrote Property Management Acquisition Blueprint, and it is available for a limited time. What I'm doing is a pre-sale currently, limited time, available until June 10th. I thought I would drop this as a founding access only, and it has quite a few different pieces to it. I have step-by-step training videos in there. They're all recorded. And I have different checklists that I included, like due diligence checklists and LOI prep and 90-day plan and all this kind of good stuff. And I'm offering it. The investment for this is $19.97. I have a couple different payment plans where you can pay upfront for the entire online session, or you can do a 3-month payment plan option. And my assistant will go ahead and drop everything into the chat. It's available only June 4th through the 10th. And then the actual course drops in your student portal on June 17th. And then as part of a founding buyer, I am also offering a live Q&A on June 18th. So you would get an email with the Zoom access to that. So it gives you a little bit of time to take a look at it and then join the live for the Q&A for founding buyers. So this is something that like I said, I'm offering and I've been asked for in the past, and I think it will be really cool. So if you have any questions, let me know, but I know my assistant will go ahead and drop some of the information in there. And then I know in the chat, everybody's been wanting your contact info, Jordan. So be on the lookout for lots of emails coming up. But so here's Jordan's contact info, and you can reach her email or on her website. And then we'll also be sending out follow-up emails as well with everybody's contact information as well. So let me know if anybody has any other questions. And it looks like the acquisition blueprint is in there in the chat. And like I said, it's just a investment of $19.97, and that will get you all the answers that you need and probably more in order to buy a property management company. So yeah.
Awesome.
Anything else?
I appreciate the time and appreciate you allowing me to join you on the Doors to Deals webinar, and happy to answer any other follow-up questions as well, but appreciate everyone's time.
Yeah, thank you. And thank you for coming. Yeah, this was really informational. And I know a lot of people have so many questions about how to buy and how to fund.
Yep.
All right. Thank you, everybody, for joining. If you have any questions, all of our contact information is in the emails that went out, and we hope to see you again soon. All right. Have a great day.
Bye.
Bye.